Yeah, I think Bitcoin's greatest risk is its success. Because as it becomes more, right now, it's not such a big deal. And, fighting it is more of a big deal. And that's it, because it's not that big a deal. As it becomes a bigger deal and more of a threat, let's say people want to sell their bonds and they want to buy Bitcoin. And they want to do that in a bigger way, like buying gold or something in a bigger way. And then there's more transaction. They lose control over that. And that's an existential risk. So yes, that's connected. The more we create savings in it, the more you might say, I'd rather have Bitcoin than the bond. Personally, I'd rather have Bitcoin than a bond. And then the more that happens, then it goes into Bitcoin and it doesn't go into credit, and then they lose control of it. So yeah, that's a risk. Watch the total value of Bitcoin right now is a little over $1 trillion. Total value of bonds is about our bonds is US dollar bonds, about $23 trillion, and so on. Not only watch the price, although in Bitcoin's case, the demand follows the price, watch the total values of those things. And as those, and plot it on a chart and watch those things and watch the flows, because if you start to see that kind of thing, you could almost see, like the blow off and, and then that kind of reversal. Right now, just to put it in perspective, some other numbers, like there's a little over $1 trillion in Bitcoin. If for gold, if you take out central bank ownerships, because central banks won't own Bitcoin as I don't believe, for various reasons that I can digress in, as an asset. And if you take out jewelry from gold, then you have a bit over $5 trillion. So if you were to look at it now, and you were to say what's a person who wants a diversification of those two things, it's about, like 80-20 right now in the world. So that's something I'd watch too, but I think those things probably are going to rise relative to the bonds, and it would transpire that way. So you want to watch those numbers and see how those go.